I think there are a couple of things that is in the trend right now. I think from an M&A perspective or from an LBO perspective, we can split it to corporate as well as financial sponsors. For corporates, let's just say, for example, pretty clear two trends that are happening right now. Number one, corporates are trying to look at themselves and see if there are any corporate inefficiencies or corporate structure inefficiencies over there. For example, if I have a non-100% owned subsidiary, should I make it a 100% subsidiary? Do I divest some of the non-core assets as a conglomerate? How do I take advantage of the very liquid local equity market? There are thinking stuff like this. Second is, given what we call a valuation arbitrage opportunity, do I, as a corporate, have the opportunity or ability to make a cross-border acquisition where the target is valued much cheaper than I myself am, so that I can either raise debt or equity for that financing? Now, there are basically implications being we have to stay very nimble and flexible in terms of dealing with this type of corporate acquisition financing. Because 2, 3, 4, 5 years ago, when we think about corporate M&A and acquisition financing, we're talking about company A buys 100% of company B, whole credit, full recourse, synergies well recognized, consolidated, no worries. Now we're talking about potential structures and transactions like, I'm a corporate, I'm trying to buy 40% of the shares that I do not own right now in a place where I don't operate. So what do I do? Do I do a recourse financing? Do I do a non-recourse financing? Do we utilize the local bank market liquidity? Do we do that at Hong Kong? Do we do that at Singapore? Do we do that at Cayman BitCo, for example? So all of this is basically making us bankers to think very hard, to think about where can I get the best deal for the client? What is the best structure? What is the safest in terms of security, guarantee, and repayment? I think that's number one. Number two, when cross-border acquisition is involved, it is very important that we all recognize that regulatory clearances can be a very time-consuming process and can have a lot of things that happens that is unforeseen. So even after you've signed a commitment, they've bid, you're happy, then we're preparing to sign a facility agreement. 3 months later, a regulatory body come to you and say that, hey, this doesn't work. So we have to be staying very flexible in terms of what can work and what cannot work, and be able to support the corporate at those moments. And separately, we do expect, and we're seeing, a longer commitment period for these type of corporate acquisitions because regulatory clearance is taking time and with risk. For financial sponsors, I think our fellow bankers here are very familiar with them, but they do have a little bit of increased activities recently because of, number one, reducing interest rate, and number two, equity market is doing a little bit better than it was. But then, as Ivan mentioned earlier as well, there's still a lot of holding period or long hold period portfolio assets which has to come out for refinancing. And what we're seeing is that because there's a lot of refinancing that is being done, and that basically echoes very well with the presentation earlier, what we are seeing is that there are many, many more club transactions because the sponsors know when the maturity of the deal is or the financing is, and they're not selling it, and there's no confidentiality whatsoever that is commingled with the transactions, they tend to go to more banks to do that. And hence, we see more deals that are being done on a club scale, and with actually the number of deals going down, it actually means that the deal size actually going up. The deal size actually going up, meaning you need more banks to do the actual very same deal. and that's basically something that we're seeing. And also, because of where equity evaluation is, we are seeing that sponsors are spending more time evaluating stuff like a non 100% own, or sometimes large minority of them, and that opens the door, as Phyllis mentioned, private credit, holdco facilities, and we have to be staying very nimble in terms of how do we take advantage of that, or how do we coexist with that. I think that's basically the 2 cents.